Oil production in this country has nothing to do with Biden administration policy, that the industry is producing oil at record levels. There are 9,000 drilling permits that have been approved and are not being used, so you should ask the oil companies. Well,
it's their fault, right?
Fox Business did ask oil and gas industrialists, and here's an example or two of what they had to say in response to Psaki. For example, American Petroleum Institute President and CEO Mike Summers.
This represents a fundamental misunderstanding as to how this process works. Once you lease land, there's a whole process that you have to go through. First, you have to actually discover whether actually there is oil and gas in that land. Second of all, you have to get a permit to actually develop that land. Right now, we actually are developing more leases than we have in 2 decades. So the White House certainly doesn't have their facts straight on this. What they should be focused on is how do we develop more of our resources here in the United States rather than depending on foreign countries for American oil and natural gas.
Another gentleman in the industry who was not identified by Fox Business had this to say.
Yeah, it's not truthful, right? And it's not truthful at all. From day one, this administration has been hell-bent with their anti-American energy holy war to shut down the production of American energy. She knows that, right? It's delaying leases. Look, you can get a lease and then they delay the permits for you to be able to do seismic and do work on it. In Alaska, they delay the ability to get a permit for an ice road, which is how we go and do exploration on these leases. They've shut that down. They've tried to kill pipelines. Day one, you saw Biden said he wasn't going to produce on energy on ANWR, even though it's in the law that he has to do it. Says shall. And then you guys you have people like John Kerry and Gina McCarthy going around to the American financial community saying don't invest in American energy. So day one, they have been focused on killing the production of American energy.
For more on this, we're pleased to be joined by James Perry. He is of Arbor Research. Jim, thanks for joining us again. Appreciate it.
Thank you, Dan. I appreciate the invite.
Well, it's good times for commodities traders, if nothing else.
Yeah, unless you're short.
Well, yeah, okay, sure, yeah. But they like the volatility. They're getting all kinds of volatility, aren't they?
Yeah, they really are. Nickel is a key material that the metal that's mined in Russia. It was up 250% yesterday, and it was margin calls at $100,000 a clip. So yeah, it's really dangerous out there.
And where do you see energy prices, particularly oil, that's I don't know, trending towards 1 Bitcoin or something? Where do you see that going?
Well, there's a big dislocation out there, and I've never been a real economist on the oil market, but I think that most of the problems are in the speculative side of the futures market. I think there's a lot of people that have really, really made a lot of money speculating on oil, and I'm hesitant to say how far it can go. I thought it was expensive at 90. Russia exports 5 million barrels a day. We, as a country, energy is only sort of 5% of private consumption, so it really shouldn't be the crisis that it sounds like on the news. I think the biggest problem is it's really emotional, and there's an absurd amount of untruthful rhetoric coming out of Washington with respect to energy independence. I find it absurd.
Here's a phrase that you never hear from a leftist. I was speaking to a friend of mine who's a grain trader. That's a phrase you'll never hear because I don't know of any that actually talk to anybody that's that is an actual practitioner in the supply and demand world. But my grain trading buddy said if Ukraine doesn't plant their corn crop, which should start in about a month, corn will likely go from $6 a bushel today to $10 a bushel. This translates into a 50 to 100% increase in meat from today's pricing.
Yeah, I think that's right. I mean, Ukraine's the breadbasket of Eurasia. I mean, it's 25% of wheat production in the world. It's a lot. And I think a lot of people need it, and I think that Putin and Chairman Xi in China have been talking about this. China needs a lot of food. They're having a bad wheat crop over there. So part of this whole cozying up between Russia and China is really about supplying the commodity needs for China. And they're the big buyer out there of everything. So they control the price right now.
I wanted to also get to this missive you put out this week that, and have you explain it, because you placed a lot of importance on it, and I won't go into the charts and graphs. You can do that, but the bottom line is you're suggesting that the liquidity of the United States dollar is collapsing, and this despite all of the asset purchases by the Fed, and you see this as an enormous problem that is looming. Explain.
That's right. That's right. I mean, I think if you look at the big picture here, there's a global shortage of dollars, and there is a global shortage of liquidity. And what that means very briefly, is that all of these companies in the last kind of 5 to 10 years, and most recently the last 2 or 3, who have issued debt, they can't issue it in local currencies. You can't issue it in Brazil and Argentinian local currencies, or Eastern European, or even most Asian. So they do it in dollars. And the trouble is that once economies slow down and their exports slow down, their dollar cash flows go to zero, and their ability to service their debt goes to zero as well. So the idea that you get a credit crunch that's based on missed payments and margin calls because you can't pay your debt back, that's the biggest problem. And this is why, if you look at what's happened in the last sort of 13 days since Mr. Putin started his ridiculous adventure, the European bank stocks are down 50%, right? And they are the ones that have companies who do business with Russia who are not going to get paid. And if some of the smaller banks in Austria and Poland and Romania have loans out to Russia, they also have loans that come from the bigger banks like Deutsche Bank and BNP. And if they can't get paid, then BNP doesn't get paid. So all of a sudden you've got balance sheets that are under severe pressure from liquidity. So this whole idea that the ECB is going to hike rates, and frankly, I know this is kind of a minority opinion, but Goldman Sachs and JP Morgan all say, and many people say, that the Fed is going to tighten 4 times or 7 times this year. And the market is telling you in the last 4 days that the odds of no hike and even more liquidity and stimulus are rising by the day. I mean, gold is up over $2,000 an ounce right now. On the news last night that the European Union is going to issue a huge amount of bonds to fund oil and gas purchases and defense spending. So the euro is up today and gold is up. And the Fed meets on the 16th, as you know, and Powell has said he got the job. He actually hasn't been officially reappointed, so he's towing the line of the administration, and the administration wants inflation down because they want to do better in the November elections. So he's committed to raise rates, but can he do it when we're going into a recession? I don't know.
Oh, going into a recession. Oh, that's an interesting statement. But let me backtrack a second. So this isn't like you're saying. This isn't the classic liquidity trap where you have low interest rates and high savings rates. This is something different because you're suggesting this balance sheet problem. There are not enough dollars for debtors to pay their bills.
Right. This is a global shortage of dollars.
And so going into recession. Elaborate on that. That's where you think we're headed right now, particularly if Powell tightens, if Powell increases interest rates?
Right. Well, the Atlanta Fed does a GDP forecast, which is kind of a real-time thing, so it jumps around a little bit. It's called GDP Now. It's a model. And that GDP model that the Atlanta Fed does has growth in Q1 at negative, right? Less than zero. And that's been that way for even before the invasion. So the economy is slowing, and the biggest problem is that wages aren't keeping up with the prices of goods that people need to buy. So real disposable incomes are falling. They're lower now than they were before the pandemic started 2 years ago.
So is Powell then in God's little acre there between the rock and the hard place with respect to interest rates? If he doesn't raise, then inflation continues to increase. If he does, then you have this. Then he exacerbates this liquidity problem.
Right. The Fed is in a pickle. They've been committed to getting inflation down. That's what the general population and the government wants and needs because it makes the papers every day and people feel it at the grocery store every day. But at the same time, if you increase overnight funding rates to Wall Street, they're going to unwind positions in these markets, stocks, bonds, commodities. And the Fed has two mandates, right? Full employment and stable prices, right? So they failed on both of those things, not by design, but by the pandemic. But there's always been a third mandate the Fed has, and that's market stability. And that's the one that matters now. Employment's going to do what it's going to do over the next couple of years, and inflation's going to probably tick up or peak somewhere around here in the next month or two or three. And every single forecaster that I read on Wall Street has inflation at half the level it is today in 18 months. So the market trades that way too. The bond market trades that way. 10-year yields are lower than they were at the highs in 2021, right? So they traded at 166 yesterday, right? Down from 220 2 weeks ago. So the bond market's rallying. Inflation-linked bonds are trading poorly. The inflation expected in 10 years is going to be something like 2.5%, not 8.5%, and that's just by the numbers. So, I think disposable income is falling. Consumer balance sheets are in trouble, and the way to solve high prices, if it's a supply issue, which I think it is raise prices high enough where demand collapses, and that's what's happening.
And this week, Biden is expected to issue his first EO on crypto, and reports are it's going to essentially try to establish sort of the rules of the game and promulgate rules consistent with the rules of the game that our European friends are undertaking. But also the suggestion that there'll be an exploration of a digital currency for the central bank. What, if any, impact does this move by the federal government to sort of, establish these rules of the game for crypto? What impact is that going to have?
Right. It's interesting. I mean, frankly, I think the government, that's the administration and the Fed and the financial system, they're playing defense here, right? I mean, they realize that people want to get their money out of the financial system because they don't trust it. It's pretty simple. And they do have to establish some rules, but the biggest risk that the government sees right now, is that if there's a global shortage of dollars and all of these companies out there who have borrowed in dollars decide not to pay us back, they'd rather pay back their trade partners in crypto, then, the need for a central clearing operation at the Fed becomes, negligible. You don't need it. You don't need a central clearing bank. And gold is up because people don't want their money in the financial system. They're worried that there's going to be a liquidity squeeze, and there could be.
And so if the federal government creates its own digital currency, the idea is, well, that digital currency is backed by the full faith and credit of the United States government, and these other currencies are not, and so there'll be a flight to that federal digital currency?
Boy, I don't know. I mean, it seems to me that it doesn't really solve any problems because you still got a central clearing system, right? And that's the reason crypto is here, is because people don't need to have somebody who's the administrator of your loan, right? You can do it direct. Mm-hmm. And the Bitcoin, as you and I have talked about before, it really is, it's designed because of blockchain technology, right? It's not a currency. It's not gold. It's a payment system. It's a peer-to-peer payment system. It's software, right? And that software and the blockchain are growing at exponential rates right now because it's cheaper and it's simpler and it's effective. And if you can get some of the bugs out of it, it's going to work. So I'm not sure what Bitcoin should trade at. I don't know what the value of it is, but I do know that, if it came out 10 years ago at $5 and it was supposed to be one, that was 5 times overvalued. And 5 years later, it was supposed to be at $50 and it was trading at 500, then it's, 10 times overvalued. And now at 38, is it worth 38? I don't know. Maybe it's worth 3, but I do know that 10 years ago, it was a fraction of 3, right? So I don't know what it's worth. I just know that the blockchain peer-to-peer business transaction capabilities on the planet are growing at 2 and 3 and 4 and 500% a year, and it's going to be here. And the government and the Fed and any central bank can't do anything about it.
He is Jim Perry. He's Arbor Research. James, thanks as always for joining us. Appreciate your insights.
My pleasure, sir. Thanks for having me.
And he joined us on our turnkey.pro answer line.
Connect with Dan and Amy using the AM560 mobile app. Download it today at 560theanswer.com/mobile.
Have you ever wondered what a groundhog sounds like? We see him crawl out of that hole year after year, but we've never heard his voice. Ah, there it is. Well, he said 6 more weeks of winter, and that's a lot.